Good evening and welcome to Seattle Wala's live video session for retirement planning and how to balance your retirement assets using life insurance today with Hari Akali. So Seattle Wala is a social media platform born out of Indians in Seattle. Facebook group working on connecting Indian community in Greater Seattle. Our goal is to connect our community members with local experts and service providers and business leaders to share their wisdom. This session is for information and educational purposes only. Today we have Mr. Harinath Ekali, who is going to cover retirement planning, how to balance the retirement assets using the life insurance. Hari will walk through the strategies which we all can learn today. If you have any questions, please type them in the chat or comment section for us, and we will get back to you on the answers. Either Hari or one of our team members will get back to you with the answers. Good evening, Mr. Hari. Welcome to Seattle Wala live podcast. Thank you for coming to our show. Will you please introduce yourself and we can get started with the session?
Yeah, sure. Thanks, Prasad. Hi, this is Hari Akali. I'm presenting a solution or different options how you can manage your portfolio during retirement. What are the options that you have? So basically, we cover about the cash value inside the life insurance policy, how you can leverage that to manage your up and downs in the retirement portfolio. Okay, let me go ahead and share my screen. Prasad, I'm just trying to share the screen. Can you confirm which screen you are looking at?
Actually, we're looking at the same screen that we can see, the same window, StreamYard.com window, yeah.
Okay, let me see. I think I exited from the share mode. Give me 1 second. It is trying to refresh. Share. Yeah, now I figured it out. So are you able to see my presentation deck?
Using life insurance to steady up the the ups and downs of it. Yes, we can.
Correct. Okay. Let me see. Okay, good. Hi, welcome. Good evening. So let's get started about today's presentation. As I mentioned earlier, how do we leverage life insurance? Life insurance, not the just a regular insurance that I am talking about. The life insurances which has a cash value inside the life insurance. So how do you use that cash value to manage your retirement assets? And basically, based on the market, your retirement assets will be up and down. So how do you study up these up and downs? So that is what the goal for today's meeting. I'm a personal financial strategist. I'm a licensed professional to help in retirement solutions and life insurance, long-term care, education funding, and a few other. This is just a brief bio about me. Okay. The first question people ask me is, what is the right way to build a financial foundation? So oftentimes people will ask me this question. Before I propose all the solutions related to risky investments, situation is similar to this one. When you are building a house, how do you build? How do you have the nice foundation? You will basically build a layout of ground, then you build
Right.
walls, and then roof. Similarly, when you are building a financial foundation for a family, you need to have a proper family protection first. Then plan for emergency fund, at least to have the money to cover your all your expenses 3 to 6 months. Then plan safe investments. Some of the safe investments are house, uh, like a treasury bonds, annuities, cash value life insurance policies. 7702 is a tax code, IRS code, just like 401k. Cash value life insurances will have the tax code of 7702. These are the safe investment. Then plan for risky investments like stocks, mutual funds, 401k, IRA, active money management. All these are directly involved in your stock market, directly or indirectly.
So
Let
each one of these would have a direct impact on our finances or the retirement plans that anybody would like to go in for, Hari.
That's right. So basically, when we usually people will have a 401k for the retirement plan.
Right.
Similarly, supplemental retirement income could be getting from annuity programs, or another approach is cash value life insurance policies. Um,
Okay.
like when you are planning for a bigger life insurance, within that you are basically bundling the multiple products. You are trying to use this product however you want to use it. So
I see.
depends on the need, you are trying to leverage this product rather than
I
buying
see.
a multiple products and use it for a single purpose.
Thank you. Yeah. Continue, please.
Yeah. Let's dive into the type of risk that you are carrying. Suppose there are two people like Mr. A and Mr. B, and both have $100. They're trying to invest. And let's look into the different scenario. Mr. A invested first year, he got 50% returns. Next year, he got 50% lost for his investment. Mr. B invested, he was not aggressive. Let's assume that, theoretical purposes, he did not receive any gains first year. He did not lose any money in the second year. Which one is best? When you look at when you really dive into the returns, Mr. A, he gained 50%, right? His returns are after first year 50% returns. So
Yes.
$100 plus 50 is 150. Next year he
Right.
lost 50% of it. So basically
Yes.
150 minus 75, it will be bring him $75. Whereas Mr.
Yes.
B, $100, he did not lose, he did not gain. So who is best in this case? Mr. B.
Yeah.
Without even considering the tax impacts, right? So that's
Right.
so all we are saying is it's like there is a huge potential to gain more, but at the same time you are prone to have a risk from the
A lot of
market.
risk. Yes.
Correct. So let's dive into the some of the impact of losses. Suppose you invested $10,000 this year, you lost 10%. What does that mean? In order to have the break even, in order to have your $10,000 back to you, next year you need to gain 11%. The moment
Correct.
you are losing more and more, so let's take scenario of 50%. You have a $10,000, you lost last year 50%, which means 10,000 become 5,000.
5,000.
Now you are trying to gain that back to $10,000. 5,000 has to be doubled, which means 100% returns. There are scenarios people will be investing into individual stocks. They will be
Right.
losing 90% also. What does that mean? If you lose 90% last year, in order to have your break even, you need to gain 900%. So all it is indicating that the more you lose, it takes longer time to gain that money back.
Recoup. Yes.
Let's look at some of the examples happened in the history. During last year, March 20th, 2000, we had 1,574 points down, which is around 51% drawdown. Basically, it
Hmm.
impacted $1.4 trillion of US retirement assets.
I see.
Yeah. So in order to get that 1574 points again, this happened in 2007. It took 7.5 years. Of course, last year was anomaly. It went sharply and went back, came back. But history is already, we have seen it. In when 2007 this exactly happened, 58% drawdown, but it directly impacted 3.7 trillion dollars of US retirement loss. So those are the biggest impacts that we have. That's why we have to really carefully plan our retirement in a such a way that you are not putting all your asset into one big bucket. Like either it could be 401k or individual stocks or mutual funds, but you need to have an alternative plan. What if scenario, if something goes down?
Yeah.
So
you don't want to put all your eggs in the same basket. That's exactly
right.
what you're saying. Yeah.
Correct. There are three different types of investment strategies. Fixed means like, for example, you have 100K into your savings in a bank account. Either you could put it into your CDs or some kind of treasury bonds. If you put it into CDs, let's say 1%, if it's a fixed, bank is kind of giving a guarantee. Whereas going into a stock market, you could get 10%, 15%, or even more, like for mutual funds. But it is volatile, right? Always it is up and down. We don't know the future of the market. We cannot preframe. If we know exactly what are the returns going to be in the market, then everybody is a billionaire.
Yeah,
exactly. Is there any third strategy that is called index strategy? How does it work? Basically, on top of the stock market, how it works is it's a kind of staircase model. So whenever stock market is increasing, this is also
I just want to interrupt you for a quick second. I think the screen that I see that you're sharing is a little small. If we can have full screen mode, that probably will help the viewers better. Hari.
Okay. I just did it in a presentation mode. Was that helping?
Okay. This looks better.
Better?
Or we can.
Are you seeing the one screen, or are you seeing the two
I'm
screen?
still seeing the other screens. I mean, your slides also. So we probably want to go for a presentation mode.
Yes. Hide presenter view. How about now?
No, did not change.
I moved from presenter window.
No, I still see your rest of the slides.
Oh, rest of slides. Okay. I changed it over here.
Or probably we should just go full screen mode. That way, this is much better. Yeah.
This is okay, right? Now.
Yeah, let's continue like this. Yes. Yeah. Sorry to interrupt you, but yeah.
Okay.
We were talking about variables.
Yeah. So what are there? So I was talking about index strategy. Is there any third strategy? So that is called index strategy. How does it is different from our variable strategy? So on top of the variable strategy, we are trying to draw a. Yeah, tell me.
I think it went back to a smaller screen.
Went back smaller screen.
Yeah.
Okay, let me see whether I can turn off this. How about now? Is it improved?
Okay, better. Yeah, yeah, great. Yeah, let's continue.
Okay.
Thank you.
Yeah, no. So on top of the variable, you are moving into a staircase model, which means basically if you reached one point, so stock market is increasing, right? So over here also you increased and reached over there. If stock market performs negative returns, then it is locking your investment. So it's pretty much your investment is protected. And then from stock market, it is increasing. So it will also increase. And the depth of this and this raise is not equal. I'll talk about that in a little detail. But this is increased. So again, market went down, but it is kind of locked your investment. Again, stock market improved. From this point, stock market, our index strategy is increasing. Market went down, and so ours is basically our investment is locked. So it is almost pretty much it is going in a staircase model. Your principal is protected, never goes down.
Goes down. Okay.
This is called index strategy.
I see.
Prasad, any questions on this index strategy?
I think it's pretty self-explanatory. It is really good that you have these pictures. I think we can continue on to the next slide.
Okay. For example, let's take, for example, you have a $10,000. Okay. So if you put $10,000 into stock market, what would have done to your portfolio from 2001 to 2011? Okay. And you have $10,000. If you invested into index strategy, how would have done your portfolio? Okay. So we know that whenever a stock market went down, your portfolio amount of money that you have in the portfolio will go down, up and down. It's what, up and down. So we know that during 2002 and 2008 and 9, we had severe negative losses that we had. So for this total 10 years, you had this 2.92% S&P 500 returns, average returns. Whereas you are doing the mimicking the index strategy, it went down basically negative returns. So your principal is protected. Okay. And it increased from here. So it also increased. And while this is increased, this is also increased from the previous point. But 2008, we saw negative returns. Okay, if we read. From there, it is kind of locked. It is whenever it increases, it is increasing from that point. Okay, you can see that smooth effect of it. So the difference between index strategy and investing into stock market is you can explain the difference between the amount of money that you had. Over here, around $19,000 you have. Over here, you have around 12,500 or something like that. 11?
No.
Yeah,
about 13,000 something. Yes.
Correct. That is the difference between this strategy and this strategy. So whenever
where you start, sorry, go ahead.
Okay. So all we are trying to show here is somebody may ask the word, okay, you are showing this example, pre-framed example during the market was downturn. So our focus is also during the downturn, right? During that time, you are trying to protect your assets. At any point of time, you don't want to lose your money.
Right.
Okay. You are smoothing the effect of increasing or gaining the money for your investment.
Right.
So, any questions on this?
So I was curious. So anytime there is a dip in the market, whatever you are at, your principal amount will stay the same. But when the market goes up, your funds also will go up and then stay there when the market falls down. You're literally saying that the indexes will actually save your money at wherever you have accumulated when the market falls down. Is that a true statement?
Yes, yes. Perfect. So these are whenever we talk about index strategy, we are not talking about the S&P 500, Dow Jones, or NASDAQ.
Right.
Those are the stock market indexes, but this is an index strategy which was implemented by the insurance company. So insurance company, what they do is they'll hire the fund managers within the company. They manage regular day-to-day activities of portfolio. But that is completely shielded from the consumer perspective. So consumers, what they do is they'll give you the guaranteed floor value and cap value. So for example, take a couple of companies. one of the company. We are not trying to give a solution directly over here, but we'll take a couple of examples. One company says that I'll give you the downside minimum is 0.75% returns, irrespective of however the market performed. If market went down like 50%, we don't care. So we are relaxed. So company is the one who is taking a risk of investing it and giving that returns to us. Okay. Suppose if market is having a positive returns, how much we are going to get it with this company? In case if you choose S&P 500, they are going to match up to 13.75% returns. So if S&P 500 returns 10, they are going to match 10%. If they return 12%, they are going to match. If it is more than 13.75, they are going to match up to 13.75. That is called cap. So you are using the strategy of guaranteed floor and cap strategy. Using that, you are going to protect your principal and gain the upside momentum. Somebody may ask about, if I directly invest into a stock market, I might get 20%, 30%. Yes, only history tells us, like, what is the average returns. Like, you don't look at from 1 year perspective. You are looking at from 20, 30, 40 years, because you are planning for this kind of retirement, right?
From data, yeah.
Correct.
Yeah. Nice.
Okay. So this is just an evolution of life insurance. Usually people, whenever we talk about life insurance, always they refer back to the term insurance. I'm buying a life insurance, term insurance for 10 years, 20 years, 30 years, but they're not talking about the lifelong life insurance. There is a term called whole life. They are giving it for the whole of your life, guaranteed, but it is only, they are giving you for 2 to 3% of returns. That is called whole life insurance. But we have a term insurance, whole life insurance in between. With the whole life insurance, the problem is you are not getting the lot of returns, but your money is guaranteed. But you ended up paying lot of premiums for whole life insurance. But whereas term insurance, you are paying very, very less amount, but you are only having the guarantee for certain period. So you have both has a positive and negative impacts. But intermediate, if you talk about index universal life, it's like flexible premiums, and returns are around 7 to 8 or 9%, and you have a returns as well as it has a cash value built inside the policy. So basically, all your investment returns are bundled into account, and you can choose however the long that you want to pay the premiums. It could be 5 years, 10 years, 15 years. Depends on your potential. So, which means you are getting the bigger policies like 500K or 1 million or 2 million, but you are buying this kind of policy. Within that, you have a lot of different advantages. So you can talk about during 1990s, index universal life insurance introduced. Average returns are around 7 to 8%, but it is giving you the guaranteed downside. So as I mentioned earlier, whenever a stock market went down, you don't have to worry about your principal. So basically, all it is saying that I'll give you 0.75% returns, even market went down negatively, 50% down also. I don't care.
Nice.
Then, so this is the evolution of the whole life insurance industry. They re-engineered and added a lot of different benefits to the one single product itself. So usually whenever we refer the life insurance, it's only death benefit, right? It's not the case. Yeah. So you are having the insurance, long-term care, cash value, and the returns from that life insurance is tax-free. Whenever you withdraw money, you don't have to show a reason for withdrawal. There are no penalties for withdrawing early. You can withdraw as part of your retirement income also, supplemental retirement income. But of course, whenever you withdraw money, that proportion of money will be reduced in terms of policy value.
Okay, but you just mentioned that it is tax-free. Can you elaborate a little bit?
Sure. For example, you bought a $1 million policy at the age of 40 years. By the time of 65, you have 600K or 700K into the account. Okay. So on the death benefit wise or LTC wise, long-term care wise, you have $1 million coverage. Okay. On the cash value, suppose during your retirement, you started withdrawing like $40,000 per year. So your goal is you are trying to leverage this tax-free benefit. So when you
Right.
are funding the policy, what you are doing is just like similar to Roth IRA. You are paying all the taxes upfront. You are
Upfront.
funding
Okay.
your policy. Whatever the growth that it has inside the cash value life insurance policy, you are not paying any taxes at all. It's every
I see.
year you are having a compound returns. Your
I
money is
see.
keep increasing.
Okay. Okay. Yeah. Thank you.
Okay. What are the other advantages with this? Just I'm summarizing the different benefits over here. Let's start with asset protection. So because it is a life insurance, suppose if you don't have a life insurance, run into, for example, Washington State LTC, right? Everybody is aware of it now.
Yeah.
And a customer run into a long-term care insurance, either his sources are either having a long-term care insurance, or he has to sell all his assets and pay for his long-term care expenses. Instead of that, basically all you are doing is by getting this insurance policy, you are protecting your asset. That's one. Flexible funding. So all these policies are not mandated to pay every month this much amount. Whenever you have additional money, you can overfund the policy, which means, let's say your premium is $200 every month. If you
Okay.
have a additional cash value, additional cash sitting into a bank account, which is not generating any income, you can
Mm-hmm.
fund more, like maybe $5,000, $10,000. You can dump into this account. You are using this index strategy, which is better than directly pushing into stock market if you are not an aggressive investor, because you need to be ready to accept the challenge of if market goes down, you should take that risk, right? If you are not that kind of
Right.
investor, you might as well put it into your funding into your own life insurance policy. That's why it is
Right.
called flexible funding. Um, for example,
Interesting.
if
Yeah.
there may be a situation where you are unable to pay the premium for next couple of months due to could be a life challenges and all that, income or job between the jobs and all that. During the time, if you don't pay the premiums, usually life insurances, it will be cancelled, right? Over
Cancel.
here, this
Yes.
is not the case. So because you already overfunded earlier, that is what it is paying back to these premiums now. And
I
as I
see.
mentioned earlier, cash value inside the policy, that is where you are drawing some of the money from there and paying the premiums for your own policy.
Premiums.
So
Yeah.
that's why you are
I see.
continuously using this life insurance. So it will not be
I see.
lapsed.
Okay.
So that's where experienced professional come and sit together with you, design the policy in a such a way that your policy is
Right.
protected. Okay.
Okay.
As we talked about earlier, these are some of the protections like long-term care, terminal
Right.
illness. Okay, so I did not cover the living benefits. Earlier, whenever we talk about insurance, as I mentioned in the previous slide, we'll always have talk about death benefit. But
Death
while you are
benefits.
living, you can also use these benefits. These are called living benefits. Those scenarios are terminal illness, like cancer, those kind of
Hmm.
scenarios. Like a
Okay.
doctor will say that this person will not live more than 6 months or 12 months. Those are the scenarios you can use. Let's say you have a $1 million policy. Based on the severity of the case, they'll say you can withdraw 50% of it. So out of $1 million, you are going to take 500K from this policy while you are living. So that is the beauty
I
of this
see.
policy. Yeah.
Okay.
And critical illness. Sometimes people will get bypass surgery, like a heart attack, and those kind of those are critical illness, right? You are
Right.
eligible to do the same thing again. And chronic
I see.
illness. So chronic illness is different from long-term care. For chronic illness, people will have a disability, kind of losing some of the physical functions.
I see.
But long-term care, you can gain that back. So long-term care is totally different. Like, out of those 6 minimal activities, if you are unable to perform those 2 activities on a temporary basis, like 1 year, 2 years, you can use these funds to utilize it.
I
These
see.
are all called living benefits.
Okay. Okay.
Yeah. So next benefit that we talked about was tax deferred cash
Tax deferred.
accumulation.
Yeah.
So as I mentioned earlier, whatever the returns that you are getting, you are not going to pay any tax at all. These are all compound returns that you are having.
I see.
Okay. What are the benefit from your life insurance policy? Let's say your kids got this, you got this $1 million policy. After you, kids will get this $1 million, right? Or a spouse. Kids or spouse will not pay any taxes for this returns, like $1 million.
That's good.
Yeah.
That's good.
And not only that, if kids are, you are pushing this to your estate, there are no taxes for your estate also.
Oh, okay. Okay. That's
Usually
good to
estate
know.
taxes are 40% to a federal
Yeah.
and 20% to the state government. Of course,
To the
there are
state,
limits and all that, especially people
definitely.
who are on H1, they don't have a higher limits. For the people who are on H1, it is $60,000. More than $60,000, whatever the asset that they have to pay the taxes to estate taxes to the state government and federal at 40% and 20%, total 60% impact. For example, they have $1 million asset, so around 600K will be lost.
600K is gone. Yeah.
Correct. That's why a lot of wealthy people, what they do is they are taking these kind of policies to protect from or hedging from these estate taxes. That's another strategy people follow.
I see.
So financial aid for the students for this college funding. Usually people will get either 529 or plan independently, right? If you get 529 plan, again, you are investing into market. So you'll have a market risk. That money can only be invested or used for studying. In case if your kid will get a merit-based scholarship, what about the money that you saved, right?
Yeah.
So that's why you have some certain restrictions over there. Or during 2008 and 9, what happened? They planned, parents planned their kids' education, save 200K. Suddenly that, because they invested into risky propositions and their money went from 200 to 100 grand. So you are directly impacting your kids' education. For those scenarios, you can nullify with a cash value life insurance. By investing into cash value life insurance, your kids' need-based scholarship will not have any impact at all. Because for college purposes, I know each one is a different strategy over here. Each strategy we can go into half an hour, 1 hour topics. But I'm summarizing. I'm summarizing the different strategies into each, bundled into one product here. What happens with the college education? So you put the application for FAFSA. FAFSA, they look into parents' assets and parents' income. So either you put it into 529 or you invest into either real estate or stock market. These are all considered as assets. Based on the asset, there is a certain proposition, like a 10% or 20% of money that they calculate and say that, oh, this parents has the eligibility and they can pay for their kids' education. Whereas you distribute, or basically you are trying to rearrange your assets in such a way that is not considered as an asset for college education. Isn't it nice that your kids are going to get, based on the, of course, assets and income, they may even eligible to get the scholarship based on the need. Right. So you are not losing. There is no impact by saving into these kind of policies. Life insurance policies are not considered as assets for college education.
As assets. Okay.
Correct.
That's good to know. Okay.
Right. So next bucket that we are talking about is a tax-free retirement. Okay. For example, we have two options. One is Roth IRA and 401k. When you put it into 401k, what you are doing is you are deferring the taxes, but when you are withdrawing the money, you have to pay the taxes. Whereas Roth IRA, whatever the returns that you have, because you already paid the taxes in the early stage, you are after-tax dollars invested over there. But there are some challenges with the Roth IRA. Not everybody qualifies. Your income has to support you. There is a 200K or something that if your income is less than that, you can fund $6,000. That's a max, right? Whereas life insurance policies, if you want to fund this policy for a whole life within 5 years, you can, depends on the age and all those parameters, you can fund like $50,000 to $90,000 also. You can fund as much as. What you are doing is you are pushing after-tax dollars over here lifelong, whatever the returns it are, you are not paying any more taxes on that.
Right. Good.
So these are all advantages with the cash value life insurance policies.
And definitely advantages, Hari.
Yeah, correct. As I mentioned earlier, one of the companies' floor is 0.75, cap is 15% if you invest into global index. Like global means S&P 500, Euro index, and Asian. So you have an option to invest into these three different markets. Usually, we always think that S&P 500 returns are 10%, 20%, 30%, but it is not the case. If you really look at the returns from, these are all published data from 2000 to 2019, average returns are 4.02 S&P 500. It's hard to believe it, but that's what it is. But when you combine the strategy of having a floor and cap, your returns are 7.94. Whenever you look at the 25 years or 20 years, 15 years, every segment, your weighted average having that global index and having that floor and cap, it is performing better than average weighted index. So one strategy is you can also simulate these kind of strategies, right? So you can go into Euro market and Asian market and S&P. You can simulate the same thing, like 50%, 30%, 20%. But the only difference is with this strategy, you are not having that floor and cap strategy. Floor means somebody else is guaranteeing that your money is protected. You are not going to lose your money. So that is what the guaranteed floor.
Nice.
Okay. For example,
you lost your screen. Yeah.
You lost your screen?
Thank you.
Okay.
No, I got it now.
Yeah. So you are, for example, 40-year-old female invested planned for $1 million life insurance. She invested 124K. Every first 4 years, 29. Like assume that 30K. Last year she already reached a capacity, so she put only $5,000. So total 124K. And you can imagine, look at this. At the age of 75, she had 683K into her account. If she surrendered the policy, which means cancel the policy and take the money out, she'll get that money, 683K. Or she can continue using keep this policy. She can get either death benefit or LTC policy. So this is one of the examples that I was talking about.
Nice.
Okay.
So quick question on your previous slide, Hari. So you had given a $124,000 contribution. Obviously, that is for $1 million. But if you want to go less than $1 million or more than $1 million, the premiums will definitely vary.
Adjust proportionately. Correct. Yeah. If you go with the 2 million, so basically you are ended up funding 60 grand. But you can spread this into 10 years, 15 years, 20 years, however you want to do it. But this is one of the strategy that you can. It's not that you have to do it in 5 years. You can customize however it fits for your needs. Yes.
And of course, depends on the age that you start doing this.
That's matter too. Yes.
Perfect. Thank you.
Okay. How does really this insurance policy works? First, 10, 15 years, depends on the, again, age. It is giving you a protection needed for that family. Later on, this become a investment vehicle and it is building a cash value for your retirement. So basically, cash value is slowly growing. So that is the fabulous thing about these insurance policies. Some people will neglect about it, but you are using this as a leverage for your retirement. You are basically accumulating all your money over here. Initially, it is protecting you. Then later on, you are turning this into a wealth vehicle.
Okay.
Yeah. So you have a different ways that you can distribute your assets because we don't know, we cannot predict the future, how the tax environment are going to be, right? If taxes are increasing, what should we do? Or taxes are, the same like this, what should we do? or taxes are going down, what is the best strategy, right? You need to
Right.
distribute your asset in such a way that you are continuously getting the income and you are also deferring the taxes, as well as you need to have another bucket for tax-free bucket.
Right.
Okay. So these are the different kind of investment. I know tax strategies, again, another 45 minutes topic, but I'm
Yeah. It's a
summarizing all
different
this
topic.
into
Yes. Yeah.
right. So earlier we talked about those three strategies, right? Do you remember, like fixed, variable,
Yes. Yeah.
and index strategy?
And
You
index.
have
Yeah.
these different kind of investments here. Which ones are the index strategies using? So as I mentioned, annuities are using the index strategy. Like, it's on the volatile market, you are having a staircase model. So this one
Right.
and that cash value life insurance policies that we talked about,
Right.
7702 IUL kind of thing. These are the
Yes.
two things which are basically giving a downside guarantee.
Okay.
This is just an industry term. Most of the companies are offering these products. Like, I could say that 20, 30 different companies are offering. We can pick and choose whichever meets your needs, and
Okay.
financially strong companies. So these are the different programs. Within the annuities, you have fixed annuity, indexed annuity, variable
Yes.
annuity. Within 7702 program, you have a whole life or universal life, variable universal life, and indexed universal life.
Index universal life. Yeah.
Yeah. If you are not savvy investor, I would suggest to go with these index strategies.
I see.
Okay. So what would be the nice and best retirement solution that you can plan? Everybody will have a wish goals, right? Similarly, you want to have a steady growth, no market risk, lifetime guaranteed income is what we wanted, and a tax benefit. We don't want to pay the taxes. That is
Right.
what we want to combine. All these four circles is bubbled up, and having that portion of central region is what we are trying to focus on.
Okay.
Okay. Let's take an example of Tom's retirement. So what he did
Okay.
was he built that. Okay, before we go into case study, any questions, Prasad?
No, we're good. It's pretty self-explanatory, and then you're doing a great job, Hari. Your explanation is good. Thank you.
Thank you. Yeah. So, for example, Tom planned for his retirement and he saved money and invested. And let's assume that for case study purposes, he got exactly $1 million at the age of 65. So he's banking on all 401k. So all his money
Right.
from 401k. For his retirement, he wanted $50,000 because he has to pay the taxes. He's withdrawing 70 grand from this 401k. What happens? So $1 million deduct 70,000 and he had 930K. That year, these
Right.
are all fictitious numbers, hypothetical S&P 500 returns. This is not real
Okay.
numbers because we cannot predict the future, right? So
Yes.
that year, let's assume that negative 14.66% is the returns. What happens to that base value? So that principal is going to go down to
Go down.
793.662.
Right.
Okay. Similarly, every year he's withdrawing 70 grand and 1% is the inflation. So that's where you can see that 70,000 plus every year inflation is increasing. He's increasing his withdrawals from this policy. And market is performing like this. And end of the year, you can see the numbers. Let's assume that he continued another 20 years. He started with
Mhm.
$1 million. Market is also increasing and going down and up and down. He ended up
Right.
having 444K. Okay. So are you happy with these numbers? So people will
Oh,
ask me, are there any better scenarios or strategies?
right.
Okay. When you really look at that S&P 500 hypothetical returns, how many times market performed negatively? 1, 2, 3, 4, 5 times, right?
Right.
Let's say if I offer a tip that, do not withdraw money when you see a negative returns previous year. Okay.
Right.
Again, the question is, hey, all my money is here. This is the only source of my retirement income. How can I live? I'll answer that
Right.
in a few minutes. But let's do
Sure.
this. let's follow that. If you are not withdrawing money from this, whenever you see a previous year negative returns, so we know that
Okay.
5 times it performed negatively. So
Mm-hmm.
5 times average $70,000. 5 sevens is 350K.
350,000.
350K plus 444, around 800 grand. So what do you think if you follow that previous strategy of not withdrawing? What do you think? Any guesses? What would be your portfolio? Is it going to be 800 or 1 million, 1.2? Any guesses? Prasad,
No.
what's your guess?
These numbers are mesmerizing, but yeah, I think it's going to go down for sure. Definitely, because again, the market volatility is something that is totally unpredictable.
Correct.
So there's no guaranteed that this year it fell. So if we don't withdraw any money, it doesn't mean that it's going to grow next year.
Correct.
What if it falls again? So
Mm-hmm.
it's a total uncertainty.
Correct. Okay, let's follow that approach. We are not withdrawing 70, those negative years, because we saw negativity, and we are not withdrawing those following years, right? So you
Right.
saw the negative returns previous year, we are not withdrawing.
Mm-hmm.
Again, you saw negative returns, we did not withdraw negative that year. Okay.
Right.
So if you follow that approach, what is happening is market is also performing, and you ended up having a $3.5 million. Let me explain how this is working. Let's
Okay.
dive into more details. What
All
had
right.
happened? So S&P 500 first, whenever you see the negative, following year you saw again negative, but you
Right.
patiently waited and followed my strategy. But
Yes.
following year, immediately you saw huge positive returns.
Right.
Okay. See, 1 year negative again at the age of 69, 7.16. Following year,
Right.
moderate returns. But
Right.
usually what happens is whenever you have a negative returns in the previous year, following year market will bounce back very hard. So that is
I
why
see.
you are seeing that at age
Yes,
73,
big
you
numbers.
saw
Yeah.
negative 5%, but following year you have a 21%. And you are
Right.
seeing the same over here also. Previous year 26%, but following year you had a higher returns. By
Right.
following that, your money is increased. One is you did not withdraw. What would have happened was, whenever you withdraw money, your money is not participated into market. That's why you are having a compound impact on your portfolio. By
I see.
not withdrawing money from that account, 401k account, your kind of principal is walked into the market and gained more returns.
I see.
So
Yeah, that's a good
having
strategy.
correct, having said that, now the question is, you are going to come back. I know. How would I live during that year?
During those
Now,
years, literally
correct,
67, 66, and 67, you did not even give any money. So what
exactly,
would we eat? How would we live?
correct. That's where our handy dandy tool comes into picture. Cash value
I
life
see.
insurance. So, for example, you started this policy at the age of 40 years. You are
Mhm.
paying average premiums are around 6,967, which is $7,000, and you
Right.
paid for 25 years. You did 175K that you paid into the policy, and all those
Right.
years you had 500K as a death benefit or LTC, and the cash value is every year it is keep growing.
Mhm.
So death benefit you have, what is the cash value that you have? You started this policy at 40, but the age of 65, you have a 233K into your policy,
Right.
500K policy, this one. So
Okay.
now you have this cash here, right?
Mhm.
As we know that cash value life insurance policy is you are not paying any taxes. Do we know what
Right.
was our original goal of money that we wanted in packet is 50,000, but because we have
Yes.
to pay the taxes for 401k, we are withdrawing more. Now you
Right.
withdraw 50 grand, then
Mhm.
your cash value is proportionately reduced, and the same amount of money is reduced in your death benefit.
I see.
Again,
Yeah.
following year also you withdraw $50,000. It reduced your death benefit. Cash value is proportionately reduced. And again, your
Reduced.
money is this money is keep on invested, right? That's why you are getting
Right.
returns from the market,
Yes.
and you are withdrawing less compared to over here. And you followed the same approach. So over here,
Right.
60,000, we applied that 55 is 1% inflation we applied over here. By the time
Right.
of 85, you still have a cash value into your account is $86,000.
86,000.
And still having a death benefit of 213K. How much we withdraw? Almost 3, 4, 5, 5, 5, 250, 265K that we withdraw from your policy.
265.
So
Yeah.
by spending 175K, you are getting all kinds of advantages with the life insurance. At the same time, that cash helped you to maintain up and downs during your retirement.
I see. Yeah. Right.
So isn't your family deserve to have this kind of returns?
I think so. Yes.
Yeah. So that's why, having another set of eyes, carefully design your retirement strategy will help your retirement, smoothing the impact of up and downs in your retirement. That is what the essence of our today's topic. Little summaries, case study summaries. It's basically you are using the power of IUL. You got it for $1 million retirement strategy. You are trying to withdraw $70,000. You ended up having 444K, whereas combining with the IUL,
Okay.
your money
Yeah.
ended up having a $3.5 million.
3.5. Yeah.
Any questions, Prasad Garu? How so far
No, this
on
is
this case study?
good. I think this is good information. I mean, our viewers who are listening, I think it is pretty self-explanatory, as you said, and then you explained it very well as well. So yeah, I think it's good. We can continue if you have more slides. Otherwise, I will actually have a few questions. FAQs. I want to go ahead
Sure.
with them.
Just
Yeah,
briefly about
I will. Yeah,
what
I
are
will
the
let you
different
finish
solutions.
first. Harry.
Yeah. Just not much. These are the different type of solutions that we provide.
Okay.
Estate planning, protection, retirement, college funding, tax saving strategies, return and risk that is what we need to consider whenever we invest something. These are all our total solutions.
Okay.
We work with 189 companies.
Very
I
nice.
only listed out top 4 different categories. So you have a protection, retirement planning, and all that on the investment side. And we also do this portfolio management, like, actively working with basically if you have 100K or 200K, you are going to engage a professional to do your portfolio management rather than doing yourself. Usually 3 to 5% average more returns than you do it yourself. We have these referral services also, like, different kind of insurances that we provide.
Very nice.
So just like, every year you are seeing the doctor for, doing your physical checkup. We are kind of financial doctors. We do this kind of 6 different areas. We'll make sure that your asset is accumulated, having a proper cash flow, maintaining the emergency fund, and estate preservation and protection, debt management also. Of course, most of the people are properly managing it, but we'll provide that kind of insight also. Okay.
Nice.
I provide these kind of different kind of financial classes just to make sure educating our community. So goal is to help the families. No family is left behind. Prasad,
Very nice.
we can go back to the questions. Do you want me to stop this presentation? I think.
If we are done with the presentation, that's good. Thank you so much. Your presentation is really, really good, very intuitive, very informative. Thank you so much, Hari. So I would just go about with a few questions I have in the form of FAQs. So,
sure.
First question, what are the ways you can take money from life insurance policy?
Okay. So I think bits and pieces I covered within the presentation, but suppose, for example, any family needs, if you have some cash value inside the life insurance policy, you can borrow some money from the life insurance. Of course, portion of, as I mentioned earlier, whenever we withdraw some money, proportionately your death benefit or LTC will be adjusted, but that is an option. Second thing is, for your kids' education, you can take money also. You can, it's like you are using this you are maintaining your own family bank. You have a pool of money,
I see.
you are borrowing money and paying back. Or there is another approach is, you can, whatever the cash value inside the policy, you can go to the bank and put this policy as a collateral. You can get a cheap finance from the bank. So for 2 to 3%.
I
That
see.
way, you are basically simulating the scenario of real estate. Real estate, you are building the equity. Whatever the
Right.
appreciation that you have, you are taking that in terms of refinance and investing into other, right? Similarly, you
Right.
can do that similar situation here.
Okay. Thank you. So are there any penalties for taking early withdrawals from the insurance policy?
Okay. So in case if you are surrendering the policy, there are certain fees. That's why
Okay.
first 10 to 15 years, depend how you planned. Like, if you pay the overfund the policy in first 5 years, within 7 to 8, first 7 years or 8 years, you don't want to withdraw any or surrender the policy. But after 10, 15 years, whatever the cash accumulated value, you are going to get the same. But for borrowing purposes, it is not having any impact. So as I mentioned, compared to Roth IRA or 401k, you have to pay the penalties. But over here, you are not paying any penalties for borrowing money.
I
If,
see.
if
So
you cancel the
you
policy, then you ended up losing some value from it.
ramifications for that. You just said you can take a loan on
Yes,
the
whatever the
insurance
cash
policy,
value. Yes,
right?
yes.
Yeah,
Let's say you have 100K. Suppose you want to take $20,000 for your kids' college education. You can do
right.
that. So you can borrow $20,000 and pay for college education. And
I see.
later on, you are going to pay. So whatever the finance fee, like 3% interest that you are paying for that, is they are collecting from you and they are putting back that interest, whatever gained to your account only.
Nice. Okay.
It's basically wash out.
I see. Yeah. Thank you. So how do business owners get benefit from life insurance?
Business owners have a multiple ways they can plan for it. One is if they have multiple partners. Basically,
Okay.
each partner is doing a cross life insurance. Let's say three partners. Three partners are getting a life insurance. If unforeseen scenarios, one partner is not, died, then other two partners are going to get his share or her share. That whatever the insurance that they taken will be paid to the family members.
I see. So
That's one approach.
that is the only way. Yeah, I was about to go there. So there any other ways you can utilize these features?
Yeah. So another approach is key person value. So basically, in an organization, sometimes one or two people are very key to the organization's success. All the success is dependent on them, right? So losing them is a catastrophic effect for the business. So you can get a key person life insurance as well. Okay, let's think about you are getting these kind of policies. How is this impact organization and the individual persons? There is one more option is executive insurance. So you can give this executive life insurance for those individuals. You are basically putting the golden cuffs on them to work with the organization.
Right.
These are the different strategies, but how does this work? Life insurance, sorry, go ahead.
Is it tax deductible? I mean,
Yeah,
all
good
this,
question.
yeah. Is it
Correct. For the organization, whatever the premiums that they are paying, it is a tax deductible. But the person who is getting it, like for an executive or key person, for those few scenarios, because they are getting this as a benefit, so they have to pay the taxes.
They have to pay the taxes. Okay.
Right. Good. For the between the partners, the organization is getting that, so it is not a benefit for the those partners. It's for the organization.
I see. I see. Okay. So is cash value life insurance better when the tax increasing environment?
Definitely. So now think about the scenarios, because what we talked about is cash value life insurances. It's basically life insurance means it's a tax-free benefit, right? Um, you have think about the scenario as I mentioned earlier, 401k versus this one. If tax is increasing, you ended up paying more money for
More.
withdrawals for the 401k. But whereas cash value life insurance, initially you already paid, and whatever the growth that you have, you're not paying any taxes.
You're
So
not paying taxes.
yeah,
Okay.
that's why it is better.
Nice. So can you compare the differences between a college funding 529 plan versus a life insurance?
Correct. Okay. So I think I talked about this briefly.
You did. You did. But if you can give us
Yeah, sure,
some more
definitely.
explanation.
Okay. For college funding, as I mentioned earlier, what are the options? Either you are simulating the scenario of investing yourself and trying to get the money for your kids' education, or people will usually go for 529. If you put it into 529 plan or invest yourself into stock market, you are getting the market risk, inbuilt market risk that you are having. Whereas life insurances, because they are giving this index strategy, there is no market risk. That's a big difference. Second, college 529 plan, because you are saving money into 529, when you apply for this FAFSA application, need-based scholarship, they look at this college funding. You have already money. Why would they give money based on the need? You cannot show that you have a need. You already have a money into yours. But whereas instead of putting that money into cash value, putting the same amount of money into cash value life insurance policy, you are basically restructuring your money. This cash value life insurance, it is not considered as an asset, so your kid may eligible. Of course, there are
Maybe,
other parameters.
yeah, definitely, yeah.
Correct.
Yeah, thank you. That good explanation. So, is it a good idea to take life insurance for kids for college funding?
So, insurance costs premiums are decided based on the age. If you take it on kid, you ended up paying very small amounts. Your accumulation will be very small. But you can show that as an example for saving account, maintaining as a saving account, or taking this as a, you are basically showing kids as a, hey, you are investing into your own life insurance, and it is a saving concept. Money is growing. You can show that as a good example, but not for college funding purposes.
College funding. So.
What you can do is you can get life insurance on yours or your wife. That way you are funding more money according to your age and amount of coverage that you wanted. And then it is basically accumulating a lot of money. From there, you can borrow some money and fund for kids' education.
Okay, so it's not a good idea to have it on the child's name.
If you are thinking about college education,
for college education, yes,
correct. So because amount of money that you are paying is very small amount.
Very small,
that's why.
Yeah. Okay, good. So how much insurance is actually needed for a family?
That's a good question. Oftentimes people will come and ask for hey, I wanted insurance for 2 million, 3 million, 4 million, but why? So we need to put ourselves a question mark. How much insurance is rightly needed? So basically a principle called DIME. D means debt, I means income replacement, M for mortgage, obligation, and kids education. E means education. So based on this, you have to put together numbers for it and decide what kind of amount of insurance that you needed. Within that, we can decide what is the getting that. Suppose you have an obligation for, it's not like a lifelong obligation for kids, right? So it's only for the first 10 years, 15 years. If the head of the family is not there, what would be the situation financially for the family and kids education, mortgage obligations? That's where you take this, do you want to take portion of the period or lifelong LTC and those scenarios, and retirement, you need to have a lifelong. But obligation, like mortgage, it's only for 20 years. Then cover that only for 20 years, or
Right.
education 15 years. So
Yeah.
Cover that portion.
So if a client comes and sit in front of you and he will disclose his requirements, you can actually design a good plan for him.
That's right.
Good policy for him. Okay.
Correct.
Yeah. Thank you. So can we get life insurance with financing?
Oh yeah. So there are some. So most of the scenarios, life insurance companies will be expecting you to pay from your own pocket. But
Right.
there are scenarios, even business owners even opt for getting a life insurance based on financing. Basically, what you do is there is a separate application process. As part of the initial stages, we have to do the analysis whether, suppose, let's say you are getting a $2 million life insurance, paying within 5 years or 10 years. You have to see whether this person can pay back or not. So that's
Right.
why we work with a lender, and we evaluate based on the situation. We'll provide a solution for them. So there is an option for getting the finance-based insurance.
And that's only for businesses, or it's for individuals as well?
Even individuals and business owners, we can do that. So whether the person has the capacity to pay back is the scenario
True.
that we have. Yeah.
True. Okay. So if we use cash value inside life insurance, what happens to the life insurance? Can you please elaborate?
Yeah, sure. Whenever you are taking money, you have to see the goal. Like, you want to run this policy, or you are only taking the portion of money for your needs. Whenever you take, let's say you have a cash value 200K. So you can take all 200K and surrender the policy. But that is not serving your original goal of keeping this policy for a long, right? So that's why how much money is what you needed, and how much you can take, carefully plan in a such a way that these policies can be there for you when you really need it. So that's why don't withdraw all the money unless you don't feel that there is no need for this policy.
Fantastic. So does life insurance have estate tax? I know you did mention about this.
Correct.
Do we have any implications for the kids?
No implications. There are no taxes. Even as part of our life, what we do is there is a specific term. We will not withdraw this money. We'll put this into estate, and that way they are not even getting a estate tax on this.
Nice.
Excluded from the estate tax.
And there is no limit for this amount.
Correct. When you are getting this policy, it's like 2 million, 3 million, 4 million. It's your affordability, based on your affordability.
Yeah. Oh, okay.
Of course, insurance companies evaluate how much assets you have, what is your income, whether you can really pay or not. That's why you cannot go and ask for $10 million and you don't have money to pay. So
absolutely. Yeah. Right. So why do I need to use life insurance for investment strategies?
As I covered that, smoothing your retirement strategy up and down, that's one. If you want to avoid, so basically, whatever the investments that we do is, we have a purpose, right? So if you are putting into 401k, we want to cover for the retirement. Or if you are investing, you are building an asset for your next generation. So those are the scenarios you can simulate over here. And by doing that, you are not paying any taxes. You are getting another advantage as well.
Right. So I could use the stock market to get higher returns, right?
Correct.
So, but there is still a
risk, market risk. Can you handle that risk? So let's imagine that, oftentimes we always think that really, do we need to really invest into insurance or not? By putting into insurance, you are getting the immediate protection. Next thing is your money is protected from market risk.
Right.
But during the retirement, what happens? These life insurances are for kind of lifetime, right? So after retirement also, somebody else is monitoring and managing our funds. So we have that protection of, risk-free from the market. Whereas you do it yourself after retirement, do you want to really manage yourself like get up in the early morning, watch the market, and see you want to
Yeah.
do it. So basically, during this your precious life, you want to enjoy, right? So you don't
Right.
want to bog down about the news and market
Right.
speculations and all that. So that's why.
Right. Nice. Thank you so much for the time. Any final word of wisdom for our viewers? All right.
Don't put all your eggs into one
Eggs in the
basket.
same
So
basket.
distribute your assets in a such a way that one can be used in a depends on the scenario situation. So you can leverage it.
Thank you. Thank you
Yeah.
so much.
Thanks,
So
Prasad
yeah,
and Seattle
of
Wala whole
course,
team for arranging this one. And
of course.
it is my pleasure to come and present over
It is
here.
our pleasure to have you, Hari. So
Thank you.
thank you, Hari, for joining us on our live session with the Q&A. And anybody have any questions? You want to follow up questions? Please type them here in the chat, and either one of the team members from Seattle Wala or Hari will reach out back to you with answers. Thank you so much, and have a good night, everyone.
Thank you, guys.